Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Thursday, March 15, 2018. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And we had another day where the market certainly wasn't able to rally. The market was mainly flat for the most part in terms of the S&P. The S&P 500 was down 2 points, and that's pretty close to the flat line. We're not going to say that was any kind of a big down day, but as you can see, we continue to wedge lower intraday, and we continue to ride this downsloping trend line. I find that very interesting. That's the market's way of telling us that this trend line is relevant and important. The Dow is up today, but I always keep in mind that the Dow is 30 stocks. It was up 115 points. The other thing is, the Dow is misweighted as an index because it's basically a price cap weighted index, meaning that the higher the price of the stocks in the index, the higher the index goes. That's not a representation of the overall market. I'm not downplaying the fact that the Dow was up 150 points. It was up 115 points. It's not a big deal. But I take my broader market analysis from the indexes that we look at in each and every day. That's the S&P 500, the Russell 2000, and then some other indexes like the transports, broker-dealers, and such, and even the NASDAQ. And that gives us a better representation than what's going on, as does the Dow. So I just wanted to throw my 2 cents at the Dow today, since it was up and everything else was mainly flat to down with a few exceptions along the way. Back to what's important. What's important is, where do we go from here? And this trend line's important, and I really have 2 cases to build. And I hate to talk out of both sides of my mouth, but I'm going to talk out of both sides of my mouth a little bit in terms of bullish and bearish. I'm just going to give you both scenarios the way I see it and some of the information that I take in, especially leading into a Friday. It's options expiration. It's quadruple witching options expiration. There's going to be a lot of index rebalancing going on tomorrow. There's going to be a lot of volume that comes in the market tomorrow, but mainly it's because of the quadruple witching options expiration. However, I'm going to build a bull case and I'm going to build a bear case. And the first is the bear case. And the reason why I still think there's more downside in this market, even despite the fact that we have this downsloping trend line, I think there's one more move lower coming in the market. First, we'll look at the intraday 10-minute chart. And there's a couple of things I want to point out that I find interesting. So remember where we were rejected yesterday? We were rejected right here yesterday, right around the breakdown candle high. The market rallied up to that breakdown candle, and the breakdown candle that I'm referring to is this red candle here. I call them breakdown candles. So we rallied up to the top of a breakdown candle, and the reason why I do that is it's just a larger candle in comparison to the rest of the candles that we see from an eyeball's perspective on the screen. That's it. There's no magic to it. Doesn't have to be a certain measurement. It just happens to be around the largest candle on the screen. If there was 2 of these, there could be 2 breakdown candles. That's fine. And a large up green candle is, you can call it a breakup candle, but I like to call it a bullish candle because we'll typically have further upside. And after big red candles or breakdown candles, we typically have further downside. Well, so we got rejected yesterday at that breakdown candle high, and then where were we rejected again today? Again at the same price level at that breakdown candle high, or yesterday's high as well, right around yesterday's high. So what that tells you is the market's having trouble rallying. That's the obvious. I don't mean to be Captain Obvious, but the market's having trouble rallying. It's being held down. And when you look at this long-standing 2-day back and forth, relatively narrow range, you know what that translates to on an hourly chart. It translates to essentially a bearish pattern. And it's not the most perfect bearish pattern on the planet, but guess what? It's a bearish pattern. We basically have a down move, and then we've gone sideways for a couple of days, and this generally will result in another down move. That's the bearish case, and I don't think it's only going to this gap. We consolidated for a couple of days over and above this gap. I like to call them gap fill areas. And that being the case, because of the 2-day consolidation over that level, it's susceptible to go much lower than that level. We actually made an attempt today to fill that gap. Wasn't a great attempt, but it was an attempt. And they didn't push the market any lower. And we rallied up towards the end of the day. Not a rally, but they pushed the market up towards the end of the day. So because we consolidated over this level, over the 100 period moving average, I tend to like my 272.50 level, whether it's going to be 25 or 50 cents on either side of that. I think that's the general area. Could we go lower? I think we could, but I think we get to somewhere in the neighborhood of 272 to 273, and if they're going to do it tomorrow, is the perfect opportunity to do it. It's options expiration week. There's a lot of rebalancing going on. The market's been down. It's been heavy. Heavy meaning it's just having a tough time getting up off the mat and getting any kind of price action going to the upside that doesn't last more than a couple of hours. Back on the intraday 10-minute chart, there's one more thing that I want to point out. When you look at this pivot low, and this is a low, so the actual number is on low. Whoops. The number is 274.67. What's the low here? The low is 274.73. So this is your absolute low as it relates to this trading range that developed over the last couple of days. So there's your low, and here's your high, which is right here. So you have your pivot low to a pivot high. And what's interesting is the exact amount of time from pivot low to pivot high that the market took to get from point A to point B. And then at point B, the pivot high, meaning point B, the market put in what we like to call a signal of a trend change. When you put those two things together, it's a pretty high probability, or a very, I should say, high probability that the market is changing direction. You had 3 reasons why. These are all the things that I discuss in my course at Lazy E Mini Trader. I'm giving you snippets. This is another snippet. You have a pivot low and a pivot high. The market took a certain period of time to get to that pivot high. At the pivot high, it put in a signal of a trend change telling us that, hey, knock, knock, guess what, trader? There's a likely and a high probability that I'm going to change trends right now. That's what that candle means. I like to call them pseudo doji candles. It's also a little tiny tail candle. Okay, so there's really 2 things going on there. And then there's another thing, which is we were also at what should have been an resistance from the same thing we just talked about before, the breakdown candle, yesterday's high, and then you retested it. So as you retest it, the market goes up for a very specific period of time, something I teach in my class. It puts in a signal of a trend change, something I teach in my course. It comes up to a previously determined resistance point, something I teach in the course, and the market changed direction. Nothing's 100%, but I'm here to tell you there was a way better than 80% chance that the market was going to change trend right at that price level right here. It was just going to happen. If it didn't happen, and nothing's 100%, if it didn't happen, that's one of those trades where you say, if I saw that trade 100 times show up on a screen, whether it was in a stock, an exchange traded fund, a commodity, it doesn't matter. Whatever chart I saw that, all those things converge at the same time. When I saw that happen, regardless of the chart, out of 100 times, I'm taking that trade 100 times. I'm not going to be right 100 times. There are going to be times when the market just keeps going for whatever the reason is, and those are the trades that we stop out and lose small and fast. We know where we're wrong on those trades. Again, I discuss explicitly where you're wrong and how you know you're wrong small and fast in the course. And here's the deal. I would still take the trade 100 times because I'm probably going to win at least, I don't know the number, but I'm going to say I would feel comfortable and confident saying that I would win 85% or more of the time given those set of conditions. So of course you would take the trade 100 times. Hopefully I drilled that one home. I think I did. Then at the end of the day, what's the market doing? It's putting in a bearish pattern. All right. So, again, it looks like we have lower to go. And that's the stance that I would have as the preferred forecast leading into Friday. However, there is a bullish case, and the bullish case is more esoteric than technical. The bullish case is, well, there's a little technical going on here. And let me just rephrase that for a second. The technical going on is the fact that we have an up move, and we've basically pulled back and are holding this trend line, and that can certainly produce another move to the upside. That happens all the time, and there's nothing wrong with it, and this is a pattern that's, certainly a bullish pullback pattern. I just don't think it's done yet. That's why I gave you the bearish case first. But the other part of the bullish case that's esoteric is the put-call ratio. It's not out of whack or anything like that. But from what I can tell, there was certainly an uptick in the put-call ratio leading up through yesterday at least. I don't have Thursday's data, but I have Wednesday's data. And you know what? The fact that that upticks tells me that there was a lot of retail traders that probably bought puts after or during yesterday's market session, thinking that the market was going down, trying to ride it down, and trying to play the downside, the bearish case of the market. And that's fine. Depending on where they bought them, some of them might have gotten paid off. But the reality is that most of those, generally speaking, on options expiration, when that happens, it's the institutions just going to whip the retail trader out of those trades, have those puts expire worthless by driving the market higher into the face of those puts. And you know this because the majority of retail traders are wrong the majority of the time on trades. That's just the way it is. They typically do the wrong thing at the wrong time, and for some reason, they do it over and over and over again. And the reason really is because they don't have a systematic approach. They're not playing with the same set of tools that you're playing with the things I'm teaching, because we would never buy the market at a high and sell it at a low. You don't sell the market in a hole after it's down for 2 or 3 days. You don't sell the market in a hole unless you have a pretty good, darn good reason to do so. And we just don't have it at hand this week, and it would be very easy for the institutions to drive the market higher. Will they? I don't know, because I actually do like the bearish case better, and maybe they get paid off, and maybe they do the dipsy doodle tomorrow and drive it down in the morning and reverse it in the afternoon. That's another possibility. We'll see, but I favor the bearish case, but I understand the bullish case based on the fact that the institutions do it to the retail traders all the time, over and over and over again. The IWM, the Russell 2000, my favorite market leading indicator. So the Russell finished down not that much today. It was down fractionally. The S&P 500 was down fractionally. It was basically a nothing day, but you see here that we did have 3 down days in a row after that doji candle. The question is, do they have another one in them? Even if they do, it really doesn't matter, because as long as the IWM is in this upper range of the chart, right? As long as we're up in this neck of the woods, all right, this is just a pullback pattern. As long as we're above these two converging, by the way, moving averages, the 20 moving average upsloping, converging with the 50, the question is, does the market even get down to these moving averages? It doesn't have to. These moving averages are somewhat of a safety net, I would say. And this is a bullish pullback pattern as far as I'm concerned, whether or not we have another down day in the cards. Either way, even if there is, I think this is a bullish pattern that can be bought unless we get some kind of crazy market activity and we begin closing below these moving averages, below the upsloping trend line that's from the long-term chart, the monthly chart. If we start closing below these levels, something else is going on. I just don't see that as the case right now. Even the VIX is making a bearish pattern. So if the VIX is making a bearish pattern and that's going to play out to the downside, we have a down move and we have a bearish wedge pattern that's consolidating, trading right up into the 20-period moving average, which there will be some overhead resistance right there. And under normal conditions, this pattern is going to play out to the downside. How much down? I don't know. It doesn't really matter. Whether we go to 13, 12, 11, lower, 14, it doesn't make any difference. I'm just pointing out that this supports the bearish case, this supports the bullish case, but again, it doesn't have to happen tomorrow. But if the VIX is going to go down, that supports the case that the market, meaning the S&P, the IWM, is just in a pullback pattern, a bullish wedge pattern that's setting up to go higher. It's just building energy for another move higher if, in fact, the VIX pattern plays out to the downside, which it looks like it's going to. We'll see if something changes. What would change that opinion? What would be the level that the VIX would have to close above for me to begin to change? Well, technically speaking, it's really up here, but that's way too far up. And there's a lot that could happen in the market with a VIX between 16.5 and 26, right? But it's really here. I would say if we start closing above that level, then there's something else going on in the market. In the market, by the time the VIX already got into this zone, the market's down already. But this bearish pattern should play out to the downside, and that's positive for the stock market. The transports had a little bit of an update, but I'm going to call it a flat day. Up less than 0.2%. We're not going to really make heads or tails out of that one way or the other. As long as the transports, and nothing has changed, as long as the transports remain inside this level right here, as long as any day doesn't close below that level, then this is still bullish. If we begin closing below that level, we might just fill the gap, and this still might be a pullback pattern and go up higher. If we begin getting below the 100 period moving average, that comes in right now about a little less than 10,400. That's something different. Then something else is going on. Here's another trend line for you. There's another safety net. So even if we got a hard sell in the transports, you have two safety nets as far as I can see it. One is the 100 period moving average, and the other is an upsloping trend line that the market would likely find support at. And it's, again, not me drawing the trend line in. The market drew the trend line in. And this is the way I look at it. This is the way I see it. And the way this is setting up, if we hit this trend line, I would expect a bounce off that trend line in the upper or bullish direction. Gold slipped a little bit today, and that's really of no surprise. Couldn't trade it. Difficult to trade in the middle of a range. That's what we've been talking about recently. But we have been talking about the fact that this was a bearish pattern developing, and how do these develop? How do these end? They end with another move in the downward direction, and guess what? This one right now has some symmetry. Not to say that gold can't go farther down. Of course it can, because this whole thing is even another or larger bearish pattern that you can make a case from down here, from up there, and this is just, it's real sloppy. But it's a bearish wedge pattern, and, these generally will finish off in a downward direction. So that's the way I see it, and that's why I keep telling you each and every night that until and unless we get a close above here, that'll turn it a little bit bullish. And then here, that'll turn it much more bullish. But, as long as the market stays in this channel here, this is a bearish wedge channel as far as I'm concerned. And this will generally play out to the downside. I know that's a bit of a busy chart, but not easy to trade. I get that. But, your brackets really haven't changed. Your brackets are, very bearish. We begin closing below there, and the market begins to turn bullish, closing above there. In between, we could certainly go back and forth some more, and that's really not a high probability trade that we can put our finger on right now. Crude oil is, in a similar camp to gold. It's deciding which way it's going to go. That's basically what's going on here in crude. Can make a case either way. We're consolidating above the 100 period moving average. I can make a case that we're doing this, right? I can make this case. You can buy the story. Okay, this could certainly play out to the downside. I can draw on the chart a bearish case, okay? And then I can come back and say, well, as long as we still stay in above this green candle low, then I can build a case that this is a bullish pattern that's forming and should play out to the upside. This is on a much more micro scale than the bearish case that I drew out on a much more macro scale from a longer term perspective. And then here we have a short term, a 6-7 day pattern that's developing. This is much more than that. I can make a case either way. So on the short term, I could say, well, this pattern will generally play out to the upside on a very short term basis, but that doesn't mean the longer term pattern won't play out to the downside. So I'm talking out of both sides on crude oil, but what I will say is if we begin closing, this should still play out to the upside, but not to say we won't have overhead resistance at the 50-period moving average. You're going to have some more at this pivot high. But this is the line in the sand. If you can begin closing above that level, that turns crude oil very bullish, and we can experience some of the higher numbers that we've spoken about in the past up in the $73, $74 neighborhood. But there's a lot of runway in between where we are and getting above these levels. Even if this little bullish pattern played out, doesn't mean it won't just peter out right up here and turn back down. That's still a nice trade from anybody that trades futures. You know, I'm not suggesting you do this. I'm just saying if you bought crude oil at 61 bucks and you played it up to 63 or something like that, that's a nice trade. That's not the point. The point is there a high probability trade? This is really the end point. Is there a high probability trade telling me that the crude oil market is going in one direction or another with a high degree of certainty? And the answer really is no. I wouldn't put my capital to work in crude oil right now. I just gave you the way I'm looking at the chart, the way I see it, but I don't have a high probability. I can make both cases. And when I can make both cases, that means there's a 50-50 shot that I'm right and that I'm wrong, which is not enough of a percentage to take a trade. It's a coin flip. I'm not taking a trade if I think the odds are 50%. In order for me to take a trade, I have to have the odds in my mind. I have to wrap my head around 70 or 75 or more percent of the time. I think a certain thing is going to happen and develop based on how the market is trading, based on the pattern that it's trading, based on the whatever I'm looking at plays out 75 or more percent of the time. If I don't feel like that, then I'm not putting my capital to work, and I'm not going to risk any money if it's just a coin flip. In gold, in crude oil, I can make both cases, so therefore it's a coin flip. So in essence, I don't have a high probability trade in either direction, but we like to look at the charts, and we like to use the charts as a learning experience to say, this is what happens if, and this is what happens if, and this is what I see on the short term, and this is what I see on the longer term. And you learn that way because sometimes there's only one thing that's obvious on the charts, and that's where you can take a trade. When there's one thing that's obvious and it plays out the majority of the time, again, not 100% of the time, but when there's one thing that's obvious, those are the times when you're going to take that trade 100% of the time. Those are the trades you want. Something like this, something like gold, you don't want these trades. This is not a high probability trade. This is not where you put risk capital. That's what the point I wanted to get across. And with that, I'm going to wrap it there tonight. It's everything I really wanted to and intended to discuss. So I will give it a wrap. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.